You're listening to Uranium Spotlight Podcast, sponsored by PurePoint Uranium Group. If you're following this market closely, you'll want to explore Behind the Curve, understanding when and how the uranium market turns, a new white paper that shows investors how to spot the cues that come before uranium prices move. And now, your host, Chris Frostad.
It's December 9th, 2025, and this week on Uranium Spotlight, a flat uranium spot price in thin trading. Kazakhstan moves to consolidate its uranium sector. Niger pushes further towards nationalized control, and China's only uranium miner surges on its Shenzhen debut. The uranium spot market closed last week exactly where it began, holding steady at $75.85 a pound after a week marked by unusually light trading. Liquidity was thin, with only scattered discretionary buying and no significant shifts in either utility presence or financial participation. Sellers were largely absent as well, with most producers continuing their recent pattern of offering minimal uncommitted material into the spot market. Activity across the term markets showed a similar pause. Buyers remained focused on long lead contracting needs rather than near-term volumes, and while several discussions continued behind the scenes, no material term awards were concluded. Enrichment and conversion markets remained tight, narrowing optionality for utilities, even though uranium prices stayed flat. The stability in spot price masked a notable reduction in visible offers relative to the past several weeks. Market participants reported that while prices did not change, depth on both sides of the market thinned, particularly heading into the December slowdown. This is consistent with the broader structural shift observed throughout the year, where producers increasingly prioritize obligations rather than discretionary spot sales, and utilities continue to shift attention to multi-year fuel cycle coverage rather than optimistic buying. For investors, the key takeaway is that price stability does not mean market softness. A flat spot market in a thin week underscores how little material is available and how narrow the runway has become heading into the new year. The contracting behavior we're seeing now is one of the cues discussed in Behind the Curve, the white paper that shows investors how to recognize when uranium's real move is about to start. Get it now at uraniumspotlight.com. Kazakhstan's lower house of parliament has passed amendments to the country's subsoil use code that would require Kazatomprom to hold 90% ownership in every uranium mine once contracts come up for renewal. The proposal now awaits Senate approval. Kazatomprom's CEO said it is appropriate for the national company to automatically receive a 90% stake in all uranium mining projects upon renewal, regardless of prior ownership structures. The company's chief legal officer reinforced that any joint venture seeking extension would see Kazatomprom or an affiliate assume a 90% position. Several contracts are approaching renewal, including ventures involving partners from China and Russia. Western producers are also exposed through large joint ventures such as Inkai with Cameco and Kazatomprom's operations with Uranium. What remains unaddressed is what happens if foreign partners do not agree to the new framework. Kazatomprom has not indicated whether non-compliant ventures would lose operating rights, be forced into buyouts, or face other consequences. What is clear is that Kazakhstan expects foreign miners to accept the new terms, and Kazatomprom has suggested that compensation or other benefits may be required in exchange for renewals. The broader geopolitical implications are significant. Much of Kazakhstan's historic joint venture activity involving China and Russia and a move towards near-total national control raises questions about where future production will flow. With Kazakhstan already the world's dominant uranium supplier, this policy shift could tilt even more material towards Russia and China at a time when Western utilities are seeking secure, politically aligned supply. For investors, this matters because Kazakhstan's tightening state control could further polarize the uranium supply landscape, reducing Western access to one of the world's few scalable production centers. This points towards a more regionalized market and greater reliance on Canada and Australia for secure supply. Niger has continued to consolidate control over its uranium assets following the 2023 military coup, expanding its actions against former operators and shifting production channels towards Russian-aligned partners. After nationalizing operations formerly led by Uranium and taking control of the site previously owned by Goviax, the government began transporting uranium ore from Sommer through Burkina Faso to ship abroad. The route is dangerous, passing through areas of limited state control, and for weeks the government denied the shipments before ultimately announcing that Niger has full sovereign authority to sell its uranium however it wishes. Tensions escalated further when Niger accused Orano of polluting air and water at the Mataluna site, despite Orano not being the developer of that project. The allegation appears aimed to reinforcing the government's claim that foreign operators mismanaged assets, bolstering the junta's case for nationalization. The broader geopolitical shift is stark. Through security partnerships and political alignment, Russia now effectively influences uranium production in the world's largest producer, Kazakhstan, and in a nation that once provided 15% of France's uranium and a quarter of the European Union's total supply. That material can now support Russian reactor exports and long-term fuel contracts that help build new political alliances and revenue streams insulated from Western sanctions. Meanwhile, Niger, facing severe financial constraints after Western aid was suspended, is under pressure to monetize uranium quickly. The recent ruling by the World Bank that proceeds from Samar sales should flow into frozen development accounts has already been ignored. For investors, this matters because it accelerates the bifurcation of global supply. With Kazakhstan and Niger moving further out of the Western supply chain, the burden on Canada and Australia grows. This tightening of politically reliable supply amplifies the long-term bullish case for uranium prices and greatly increases the strategic value of jurisdictions that remain stable and open to Western utilities. China's only domestically listed uranium mining company delivered a dramatic market debut last week, with shares tripling on their first day of trading on the Shenzhen exchange. The new listing is part of a broader effort to raise capital for China's rapidly expanding nuclear program and to increase transparency across the nuclear fuel cycle. The company, a subsidiary of China National Nuclear Corporation, controls China's domestic uranium production, though the country remains heavily dependent on foreign supply to meet its reactor build requirements. The strong market reaction reflects both investor enthusiasm for China's nuclear expansion and the scarcity value of a pure-play uranium miner inside the world's fastest-growing nuclear market. China plans to accelerate reactor construction through the next decade, and its fuel needs already exceed domestic production capacity. While the IPO proceeds provide additional development capital, the broader signal is even more important. China is positioning its uranium sector as a national strategic asset that deserves both market visibility and substantial long-term investment. This debut also aligns with China's strategy of expanding control over upstream nuclear fuel resources internationally, including joint ventures in Kazakhstan and partnerships across Africa and Central Asia. The listing strengthens CNNC's financial footing as it seeks to secure more uranium for the country's rapidly growing fleet. For investors, the key takeaway is this. China's move highlights how aggressively reactor-building nations are positioning themselves for future fuel needs. As China invests heavily in upstream capacity, Western utilities face even greater pressure to secure long-term supply from stable jurisdictions before competition intensifies further.
Before we wrap up, if you haven't yet read Behind the Curve, Understanding When and How the Uranium Market Turns, it's worth your time. It explains the real signals that reveal when uranium prices are about to move, long before the headlines catch up. Order your Behind the Curve white paper at www.uraniumspotlight.com. You've been listening to Uranium Spotlight, your weekly podcast dedicated to the latest developments shaping the uranium fuel market and its role in the global energy landscape. Sponsored by PurePoint Uranium Group. While our passion for this sector is undeniable, remember that nothing discussed here should be taken as investment advice. Our goal is to provide a clear and balanced view of the factors influencing uranium prices. Join us again next Tuesday for Uranium Spotlight.